My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. But people, my friends, I'm just trying to make you a little money. My job is not just to entertain, but to explain crazy days like today. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. Now, look, this market's become real simple. Stocks that benefit from rate cuts get bought. Buy. Stocks that don't benefit get sold. Sell. So if today where the Dow gained 203 points, a lot of rate cut beneficiaries in that index, while the S&P lost 0.5% and the Nasdaq tumbled 1.28%, not a lot of beneficiaries there. We need to think about who wins and who doesn't once the Fed starts cutting interest rates. Something that likely won't happen tomorrow when Fed Chief Jay Powell speaks, but might come as early as September. Fortunately for many of you, there are a lot of rate cut winners out there. Yesterday, for example, we saw McDonald's rally on dramatically weaker numbers. Well, things have gotten so weak that people are avoiding fast food until the prices come down. Hence why McDonald's rolled out its new $5 meal. Very smart. But this market doesn't care that it's doing badly. It just treats the golden arches as a rate cut winner because the company's got some economic sensitivity, certainly more than we ever thought. Now, today's turn is Stanley Black & Decker. The toolmaker's been working to cut costs, and today it delivered a good enough number that investors can imagine how profitable it'll be once rates come down. Investors are dreaming. I like the dream. It's called leverage. Stanley Black & Decker's levered to housing turnover, so it's levered to lower rates because when the Fed starts cutting, you'll see more existing home sales and more remodeling. It's why we have a nice-sized position in it for my charitable trust, which you can follow along by joining the CNBC Investing Club. Hey, the banks work too. They need to start making loans again, and they need economic activity instead of obsessing about how much they make by sitting on your deposits. Hey, thanks to Betsy Grace, the always present Morgan Stanley bank analyst, who pushed the banks hard today, made a big splash, got them all moving. See, she recognized that this is the point in the business cycle where banks can really shine. Plus, they buy back a ton of stock. You know what? We're going to be talking to one of these very banks. One of my favorites, Huntington Bank shares out of Columbus, Ohio, if you stay tuned. The stock's already up 19% for the year as part of the great broadening that I keep talking about. We're seeing the aerospace stocks soar, stocks like RTX, which makes jet engines and services them. Or how about stocks like How I Met Your Mother? Our quaint nickname for How Met Aerospace, we're really funny, which makes fasteners or screws for the aerospace industry. Both RTX and How Met are screaming higher because, as the team from Howmet mentioned on their conference call, aerospace is indeed cyclical. The industry benefits from lower rates because the businesses buying airplanes often do it with borrowed money. So rate cuts are nirvana for them. They help travelers, too, so there will be a lot of demand for planes from airlines. Same kind of thinking is going on for the rest of the industrials, which is why that group is just doing terrifically. Hey, you know what? Oh, that's all fabulous, right? Unfortunately, this stock market, though, is not built on rate cut winners. For years now, it's been rallying on the strength of precisely the companies that don't need to borrow money, that don't need rate cuts. Companies that therefore won't see much of a boost when we get rate cuts. Companies like tech stocks. Yes, tech stocks. They're just very strong businesses with suddenly very bad stocks, at least for now. At the risk of stating the obvious, what we loved about the Magnificent Seven, Alphabet, Amazon, Apple, Meta, Microsoft, which reported tonight, Nvidia, and Tesla, what we love was that rates didn't matter to them. They had such strong businesses. That's how they could go up for most of the last 2 years. They're the ultimate secular growers, which is why they didn't get dinged that badly by the Fed rate hikes. But the flip side of that is that they won't really benefit as rates come down. The Magnificent Seven, the companies, will be doing just fine, regardless of where the Fed takes interest rates. But their stocks, very different story. The answer is their stocks are and will be losers. And they'll probably keep losing until their shares come down enough to look cheap versus the rate cut winners that are rallying now as part of the great broadening. Now, that could be some distance from here, which is why one of the reasons that when you see a weak number from any tech company, like tonight with Microsoft, sellers just come out of the woodwork and they just blast the darn thing. I mean, it's just incredible. People don't even know how it's doing, and they just sell it. For tech, the watchword is 3 words that my staff loves to be able to say. And those 3 words are, get out now, which is a fabled reference to something that I did when, if you have Read Confessions of a Street Addict, I should have bought all those companies and crunched them, except for I wrote it. Consider the case of Nvidia, which is doing amazing things with generative artificial intelligence, generative AI, and accelerated computing. Those are the two biggest trends of our day. Those are basically their own cycles with their own rules, and they have nothing to do with the Fed. That's something we love them for. Not anymore. That's how Nvidia stock has become a wasteland. I mean, it's this interstitial gunfire. I mean, every day. I mean, thank heavens that the market stops. Thank heavens they ring a bell. Because then it can stop going down. Okay, sure, it's still up 110% for the year, but it's now down more than 35 points from its high, 140 to 104. I don't see it stopping here. That's not because Nvidia's business has deteriorated. Its products are selling amazingly well. Its competitor AMD on tomorrow and Squawk on the Street saying good things. It's because Nvidia doesn't benefit from rate cuts, so its stock gets kicked to the curb in this environment. The money you get back from selling the company's shares that are being redeployed are to the rate cut beneficiaries. No insult to Nvidia. It's about the stock, not the company. So why not get rid of the stock? Because Nvidia stock is getting cheaper as it goes down. Right now, the street expects them to earn $3.59 per share next year. But if this is anything like the Nvidia we've seen in the last decade, those estimates are probably way too low. Maybe so low that the company could eventually earn $4.59 per share next year. In that case, you've got a stock that could be selling at less than 23 times next year's earnings. I am not selling the greatest growth stock of our generation at 23 times earnings. I'd rather risk taking some pain. And maybe then, keep in mind, Nvidia is the premier growth stock of our time. I'm going to say it again. It's not going down just because skeptics feel there's no good return on investment AI. It's going down because Wall Street's become a lot less willing to pay up for the earnings of growth stocks. It's called multiple contraction. Right now, investors would rather chase cheaper stocks of companies that will get a massive earnings boost from lower interest rates. Think Stanley Black & Decker. Wall Street at certain junctures falls out of love with great growth stocks, abandoning them for cyclical stocks that will do much better in an accelerating economy. The year-over-year comparisons are just much better with these rate cut beneficiaries than they will be with the Mag 7. The market runs on these companies. But at some point, a stock like Nvidia gets so cheap, so darn cheap, on an earnings basis, can you believe it, that the selling will stop? We just haven't reached that level yet. I don't mean to be picking on Nvidia. Microsoft, Meta, Amazon, Apple have all been experiencing multiple contraction. Meanwhile, stocks like Stanley Black & Decker or the banks are experiencing multiple expansion. Glorious. Now, we hear that many smaller cap stocks are winning here. It's the big techs donate share to them. Donation is a very tricky word, though. What's really happening is that big institutions aren't doing anything different than they usually do. They always sell the stocks that don't need the Fed to make the estimates and buy the stocks that will put up huge year-over-year earnings growth with the help of rate cuts. Of course, there are stocks that are basically bits and bobs. Procter & Gamble and Merck missed the numbers today. I can tell you if it weren't for China, those stocks would have actually gone higher. I'll go over China losers later in the show. Eli Lilly keeps going down because it's been up a lot. It suddenly has GLP-1 competition. But it's also suffering from the same multiple contraction as the Magnificent Seven. We don't know when that will stop either. A quality company, real bad stock. It's so easy to just dump all the great growth stocks that have done so well when you have cycles based on cell phone refresh or PC refresh or AI or accelerated computing. You sell them and you will feel so instantly relieved. You'll be like, oh, a steamer trunk removed from my back. Never forget, though, that you're selling winners, actual bona fide winners for stocks that were losers just 2 weeks ago. Selling winners for losers is indeed a longer term a mug's game, unless you think this rotation has immense multi-year staying power or you're a hedge fund with the ability to flit in and out all day and all night. For the Charitable Trust, we've trimmed many of the amazing winners of this year to buy hitherto losers like Stanley Black & Decker. We could bask in the win, if only because but we can't because we still own so much of the Magnificent Seven. But like politicians, we must ask ourselves, are you better off now with the cyclicals than you were with the secular growers? The answer, here's the bottom line. You're not better off if you only own the cyclicals while waiting for the rate cut cavalry that never came and still hasn't come. But unless you think that Nvidia's General Custer, you should come out ahead when we fully discount the rate cuts that are ahead, even though there could be plenty more pain than we have so far had with the great broadening as it unfolds. Let's go to Wayne in California. Wayne.
Hey, booyah, Jim.
Booyah, Wayne.
You are the man.
Really? I'm the man?
Thank you for helping so many families across this amazing country.
Wayne, thank you. You know, you don't feel like you're helping people when you see Microsoft drop or Nvidia drop. So when I speak to Wayne in California, I suddenly think maybe I'm not a total dope. How can I help?
Well, I need your help. Uber earnings are August 6th.
Yeah.
Why has Uber dropped so much in the last 2 weeks? And what do you think is going to happen in Q2?
Okay, Uber is trading as a function of a multiple contraction. So in other words, what's really going on here is people are just willing to pay less for the losses that Uber might have. And when that occurs, what you have to do is just kind of hold your nose and hold it if you think it's going to be a great growth down the road. And that's what I think it's going to be, a great growth stock down the road. Take a look at the way Airbnb managed to get through a couple of declines. That's what I think can happen with Uber. You need to stick with it. But it's nothing to do with the business. It has to do with the stock. Let's go to Georgie in Pennsylvania. Georgie.
Hi, Jim. I've been a member of your club since its inception, and I cannot thank you enough for the education.
Thank you. We're trying so hard. Jeff and I are trying so hard. Zeb putting out great stuff. And I really appreciate it because now we know why we do it. We do it because of you, not because we just necessarily think we're like really great. We're just trying to help. So thank you.
Well,
How can I help you?
It's not only education, you are growing my investments, and that was the goal, right?
Yeah, I should have retired years ago if I felt that I didn't have anything to contribute. I had a lot of things I want to do in my life, but I like this club, and it makes me feel good because of people like you, Georgie, okay? I can do a lot of other things in my life at this point, and I just like helping people. No cynicism.
Thank you for what you do.
Thank you.
I have an important question to ask you, Jim. When I retired, I started 3 custodial accounts for my 3 grandchildren who are now 16, 15, and 13. And with the intent that when they graduate from college, they'll have a nest egg. And I transferred, all the years I worked, I held on to Disney. So my cost basis for Disney was $31.31. I transferred 100 shares into each of their accounts. However, as you know, the day it transferred, it reflected differently. And they are reviewing their accounts with me, which I love, Right. But here's the thing. I know hopefulness is not a strategy. I want to believe in Disney, but I'm perplexed on whether to let that lie in there or cash it in for what will look like a loss so they won't have to pay taxes.
Right.
And invest it in something else.
Okay, so Georgia, here's the way I have to think about this. We care about the fundamentals. We don't care about taxes. Here's what you need to know. Disney traded all the way up to 120 when Nelson Peltz got involved. I think it can get there ultimately, but I wish Peltz had gotten in. By the way, I was totally right, and so was Nelson. So I'm really tired of hearing about the belly aching from the company. The company screwed up. It's got to do better. If it doesn't do better, it's going to be on the firing line. And there's nothing wrong with that. If we were talking about the Eagles and they dropped 5 games at the end, you think I'd be happy? And my trust owns some Disney, but it doesn't own any of the Eagles. Don't get swept up in Fed rate cut rumors. I think as this rotation continues, you got to stay focused. Remember which stocks are proving winners in this market, and don't give up on all of them. You can give up on some or take some profits, but not all of them, please. On Mad Money tonight, the IPO market is showing signs of life, and last week we got one of the players in the occupational health space that we want to take a closer look. It's kind of interesting. It's called Concentra. Then copper has spent the last 2 months melting down, even though people thought this would be a super cycle. What does the commodities price action mean for stocks? I'm going off the charts to find out. And just ahead of tomorrow's Fed decision, I'm hearing what Huntington Bank shares has to say about a timeline for potential rate cuts when I sit down with the CEO. Thank you so much to the callers for saying such good things. It was a very trying day. And stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Last week was a huge one for IPOs, like I told you last night when I covered Lineage Inc. But there were 3 other big ones, including at least one that might be worth owning. I'm talking about a company called Concentra. Now, that is the largest provider of occupational health services in America, which was just spun off by its former parent company, Select Medical Holdings, and began trading independently last Thursday. Now, this one caught my eye because right now we've got a quiet bull market in healthcare providers. Just last week, major hospital operators like HCA, Tenet, and Universal Health all reported amazing numbers. I wouldn't be surprised if Concentra is doing just as well. I also like that this one's a spin-off. Wall Street loves it when big companies break off to smaller, easier to understand businesses as their own entities. Think of like GE Vernova. So let me walk you through this one. Concentra has 547 standalone occupational health centers across 41 states with 151 on-site clinics at employer work sites and a telemedicine program. The vast majority of their business comes from those occupational health centers, though. What is an occupational health center? They handle workers' compensation and provide physical rehabilitation. They do drug and alcohol testing for employers, along with physical exams and preventative care. They also do some consumer health services. These places can provide urgent care treatment for injuries and illnesses. Still, nearly two-thirds of their visit-related revenue came from workers' comp last year. Reliable business. For the most part, Concentra's customers are employers, not the actual patients they serve. I like that, too. This company partners with every single member of the Fortune 100. Can you imagine that? And 95% of the Fortune 500. And who ever heard of these guys? For what it's worth, Concentra seems to be pretty good at what they do, which is getting injured or sick people back to work as quickly and inexpensively as possible. From a study of 500,000 workers' compensation claims, Concentra had 25% lower average claims costs, 61 fewer days per claim compared to the average competitor. But I don't know how they pull this one off. But I am sure their customers, the employers, appreciate the savings. Even if the workers they're treating might feel differently, I don't know. Basically, this is a niche healthcare provider for employee health, something that's extra important given that we've got a persistent labor shortage in this country. At the same time, we've got an aging workforce that's more likely to get sick. I like the demo. Now, if you like the occupational health space, then you have to like Concentra because it's the largest player in the industry with the best results. They plan to keep taking market share while expanding into adjacent areas like workplace safety and specialty healthcare. Now, I certainly like the Concentra stock hasn't run away from us yet. The bankers marketed this IPO with a price range of $23 to $26, but the deal only priced at $23.50, the low end. Then the stock actually traded below that level. On Thursday, it's now $22 and change. No hype for this thing whatsoever, in large part because I think its former parent company still owns a huge slug of stock that they plan to distribute to their own shareholders, many of whom may choose to sell, which is kind of like let's just say, a big impediment to getting really excited about a stock. Still, I think that this will create a buying opportunity in a company with great fundamentals. When you look at the numbers, Concentra's got a lot going for it. Even though it's been putting up low to mid-single-digit revenue growth, its profitability has been just terrific. The only issue here relates to Concentra's spinoff from Select Medical. With last week's IPO, Select Medical was selling new shares in Concentra, representing an 18 to 20% ownership stake. So they didn't sell their own existing position. Select Medical still owns around 80% of the business, but like I told you, they plan to distribute these shares to their investors at some unspecified point in the future. Judging by how these spinoffs usually go, it'll likely happen in a few months, but we don't know. Last week's IPO raised roughly $529 million, but every penny of that went to paying back some intercompany debt that Concentra owed to Select Medical. At the same time, they took on $1.5 billion in new debt of their own. Not the cleanest balance sheet, but the leverage ratio is 3.9, which is not particularly onerous for a reliable healthcare company. So should you be stepping in to buy shares of Concentra after its somewhat tepid debut? Let's start with this. I like the fundamental story, no denying it. The occupational health space is intriguing. And with a still very tight labor market, I think that services Concentra offers will be in high demand. Remember, the customers are the employers, and employees are eager to keep their workforces healthy and ready to. Employers want to keep everybody healthy, right? They got to get them ready to work. At the same time, I suspect that this occupational health space faces less regulatory risk than the overall healthcare industry, like the classic hospital stocks. Now, it doesn't hurt that Concentra is the best in class at what it does. But when it comes to what you should be willing to pay for the stock, I think you should wait a bit. With this thing at $22 and change, let me do some back-of-the-envelope math so you know where I'm coming from. I think Concentra could easily earn $1.05 per share this year, meaning it currently trades at around 22 times this year's earnings estimates. Feels a bit high to me given the slower growth. I don't know of any direct comparisons in the occupational health space, but the three big hospitals that reported last week, well, they sell from 14 to 16.4 times this year's estimates. Okay, this year's numbers, we should say. See, now think about that. That's dramatically cheaper. Select Medical, which is Concentra's soon-to-be former parent, trades at 18.6 times this year's numbers. Even if you assume Concentra deserves the same multiple as Select Med, then you'd be talking about a $19.50 stock. I like that level, down a little more than $3 for here for its potential entry point, and I think you'll be able to get that price as long as you're patient. Remember, Select Medical still owns 80% of Concentra, and they plan to hand those shares over to their investors at some point, likely before the end of the year. When that happens, you better believe some Select Medical shareholders will just dump their Concentra stock. Sell, 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 sell. something that could push this thing down quite a bit. But that would be your buying opportunity. So, intriguing story. Bottom line, now that Select Medical has spun off its occupational health business as Concentra, I think this one's worth putting on your shopping list. Just hold off on the actual buying of the stock until Select Medical distributes its remaining stake in the business to its shareholders. At that point, I bet the stock falls below $20, and that's where you can do some buying. Mad Money is back after the break.
Coming up, is Dr. Copper predicting a summer swoon for the market? Cramer's going off the charts for a checkup. Next.
We need to talk about copper. For the past 2 months, copper's been melting down. It peaked right around the time when we were hearing about a copper supercycle. And that matters because this industrial metal is a pretty consistent gauge of how the global economy is doing. We're right on the verge of a big Fed meeting. So you need copper for construction, and an economy without construction is an economy that's not doing well. That's why tonight we're going off the charts with the help of Carly Garner, a terrific technician who's the co-founder of DeCarly Trading, the author of Higher Probability Commodity Trading. She's our resident commodity expert. We got to get a better read on copper and what it may mean for both the stock and bond markets. Keep in mind, Garner's pretty cautious on stocks right now. She highlighted the sell-off in copper to us back in early June and explained that a top in copper prices will often lead to a top in stock prices, albeit with a certain amount of lag. And it's not immediate. Back then, Garner viewed copper's reversal from its all-time high as a sign of economic dysfunction because Dr. Copper is the textbook bellwether for economic growth. On the other hand, though, declining copper prices also signal deflation, which Garner views as a bad thing, although it's not bad for bonds. But given that we're waiting for the Fed to beat inflation and cut interest rates, I see it as a good thing, as long as it's temporary. 6 months of deflation would be fabulous. A year or two of deflation would be disastrous because at that point, it takes on a life of its own. Now, while copper's historically been a good predictor of where the stock market may be headed, Garner pointed out that it usually takes 2 to 6 months before stocks follow suit. In the 2 months since copper peaked, it's fallen from $5 and change to just over $4, and she could see it sink all the way to $3.80 before it finds the floor. Yet even after that decline, the S&P 500 is still up about 100 points from where it was trading when copper peaked, so something's wrong. To Garner, this is a serious problem. History says the impact of weaker copper prices will start showing up in the stock market within the next 4 months. After a day like today, you start thinking, is this showing up now? She thinks it should make you more reluctant to buy the dips. Notice no one came in today. In her view, the lower copper falls, the more dangerous the stock market becomes. So either stocks need to sell off in order to catch up with the deflationary trend in copper prices, or copper needs to rebound to make up the difference. She's betting that the former scenario is more likely than the latter. Why? For starters, Garner believes the meltdown in copper is far from over and it could have a lot more downside. So I want you to take a look at the weekly chart of the copper futures with data from the CFTC's Commitment of Traders report down at the bottom. Remember, we love this data because it shows you how all the major players are positioned. They measure the net long or short positions of small speculators, meaning home gamers, large speculators, meaning money managers, and commercial hedgers, meaning actual companies that use copper and trade the futures as part of their business. Given the impact of institutional money managers on the market, Garner mostly cares about what the large speculators are doing, okay? That's the green line. When you look at the data, these large speculators still have a pretty prominent net long position. Okay, this tells you that it's long. Perhaps because they saw the steady use of copper in both the data center build out and, more importantly, electric cars, which are real copper hogs. Historically speaking, these money managers are quite bullish on copper, even as the price comes down. To Garner, this looks like an extremely crowded trade, too many people leaning one way. And she's betting the bulls will have to keep liquidating on the way down, something that could push the price of copper well below $4 and far from its super cycle status. For perspective, according to the Commitment of Traders report, large speculators held a net long position of roughly 72,000 contracts near the top of the copper market. And that was 2 months ago. That position has since lightened to about 59,000 contracts. By contrast, when the most recent copper rally got rolling, the large speculators had a net long position of just 8,000 contracts. In short, there's a lot more room for downside here because there's too many people crowding in on this trade. Now, check out this chart of the seasonal pattern in copper prices. This shows you how copper tends to trade over the course of an average year. Garner notes that the red metal tends to find an annual low in late August or September, okay? In other words, she could see it bottoming in a month or two, at least temporarily. But before then, copper could be in for a serious beating. When you look at the weekly chart of copper, Garner says it tells a straightforward story. There's a significant floor of support at $4, okay? So you got to take a look and say, all right, well, look, it's already cut through here. The signal for it right here. But that floor likely won't hold, she says. She's betting that we'll see copper at $3.80 before it finally exhausts itself. So it should go right here to there. And your biggest worry is that it's going to crash through here, right? So see, not only is $4 a key psychological support level, but it's also the 200-week moving average, okay? For 2 years prior to the most recent rally, that level functioned as a ceiling, keeping a lid on copper. So you can see that copper wasn't able to break through that for a long time. Now that we're headed back down, that previous ceiling of resistance has become, as we know, a floor of support. That's how it works. However, Garner suspects that there are a lot of traders who caught on the wrong side of the sell-off. That's what we saw in the Commitment of Traders report. So as she sees it, any reprieve in selling will simply bring out more sellers who've been waiting for the opportunity to jump ship. This is a broken chart. At the same time, the relative strength index, an important momentum indicator, has been plunging, but it still hasn't reached oversold status where you'd likely expect to bounce. That's why Garner believes copper won't stop falling until it hits the trend line at $3.80, okay? There's the trend line. It's going to come through this. It's going to stop right there. But she can't rule out a quick probe down to 350, so it might even go down there before a capitulation bottom gets really, really ugly. So really, we just think about this. Look at this. That is just horrible. Plus, don't forget the stock market tends to peak 2 to 6 months after copper prices. We've now entered that time window. When copper topped out in May of 2021, the stock market peaked 6 months later, and we got a brutal sell-off over the course of 2022. When copper bottomed in July of 2022, the stock market found its lows about 3 months later. And look, this is not some one-off pattern. It's one of the most reliable patterns in the business, which is why everyone says that copper's a bellwether. If history repeats itself, Garner says that bulls should patiently wait for a better entry point before they start buying stocks aggressively. I thought this was good on a day like today where the Nasdaq's falling apart. On top of that, she thinks that you might want to wait for a bottom in copper before you get too bullish in the first place. How about the daily chart? When Garner looks at this action, she sees more evidence that the $4 area is acting as a potential pivot. Now you can really see what we're talking about, okay? But given that copper's already fallen through this 200-day moving average at 415, she again thinks there should be more downside, even though the relative strength index has reached oversold territory in the daily chart. In her view, there are simply too many bullish copper traders who need to unwind their positions. And you can see this is where it looked like a big fake out, but you can see what's coming here. Here's the bottom line. The charts interpreted by Carly Garner suggest that copper's got more downside. And sometime in the next 4 months, that should start bleeding through to the stock market. I think it's definitely something worth watching, but I wouldn't write off the entire market off this. It's just that we'd have a different set of winners and losers than we currently are experiencing at the very moment. Let's go to Steve in New Jersey. Steve.
Hey, Jim. How you doing?
I am doing okay, Steve. How about you?
Oh, I'm hanging in there. You know, I'd like to start by thanking you for all the instructional, educative, and great investment advice I got from you over the years.
Thank you, Steve. I have to tell you, it's been a tough couple of days. I come in every day and speak to Jeff Marks, who's my partner with the Charitable Trust, and I say, darn, how do we screw up on this? How do we screw up on that? And when I hear you, it gives me faith that I ought to be taking a little more solace about the things we do get right. How can I help you?
Good. Well, I purchased Boise Cascade after speaking to you when the stock was at 55. I bought it after a strong buy opinion from you, and then I sold a third at a nice profit, and right after that it soared, followed by a big drop to 117. And I called to see if you would buy it there, but I didn't hear back from you until this morning. In the interim, it shot right up again. I think it's over 140 now.
Yes,
so
it is.
Well,
Pardon? I'll tell you, I think that it would be a good level to let's do this. I mean, we may be in a kind of a nasty period right here, but this is a kind of stock that does well in this environment. I would take a little off the table because it sells at around 14 times earnings, and this is a heavily cyclical stock, but I wouldn't do more than that, and then I'd let the rest run. Because if the Fed starts cutting, you're going to continue to see upward pressure, as we would say, on the stock of Boise Cascade. I'm very glad I made you money in this one. This is a company that my father used to work for. I always respected it, but I could not believe how much it's made a comeback in a different guise. Thank you so much for your kind comments. All right, the charts stripped by Carly Garner suggest that copper's got more downside, and she thinks it could bleed into the stock market. like I said, I'm not so sure, but I'm trying to show you contrary views to mine. This could give us a very different set of winners and losers. I don't want you to write off the market entirely because of copper. I just want you to process it in your head. Keep it as a variable. Much more made money, including my suits with Huntington Bank shares. These bank stocks have been incredibly hot. With this July rotation favoring the regional banks, I'm seeing where Huntington fits in with the CEO. Hey, then there is one huge aspect of this market that's hurting stocks, and I'll reveal what it is and how you can invest around it. And of course, all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer. In the last few weeks, as part of the great broadening of the bull market, we've seen some monster runs in the regional banks. Everything from the worst of the bunch to actually the best of breed. Take Huntington Bank shares, based out of Columbus, Ohio, one of the best operators in the business. Here's a stock that's up almost 15% over the course of July, in part thanks to the rotation, but also because they reported a great quarter just 2 weeks ago. At this point, the stock's flirting with its 52-week high, so is it time to ring the register, or maybe it's got a lot more catch-up to it. The darn thing yields 4%. It's got a real good franchise. Let's check in with Steve Steinauer. He's the chairman, president, and CEO of Huntington Bank shares to get a better sense of where it's headed. Mr. Steinauer, welcome back to Mad Money.
Thanks to be with you, Dr. Cramer.
Oh, I always prefer that appellation to others. Now, Steve, I'm going to bounce a thesis off you. For the longest time, what we cared about was this net interest income, and it's kind of written net interest margin. It's really not bothered me. I like banks that lend. I like banks that grow. Do you think as we're on the verge of a rate cut cycle, we can start valuing banks again for what they really do, which is be good lenders?
I do, and I do think we're on the verge of a rate cycle, and banks have largely come through their RWA diets that many went on last year. Capital's in good position. Credit's performing well. The banking system can be part of the next phase of economic growth.
No,
and we will at Huntington.
Well, I do want to point out that you came on our show multiple times and assured us that you were going to come out unscathed. You did much better than that. So I'm wondering whether you're not the franchise for one of the great growth areas of this country, the go-to franchise.
Well, we are incredibly well positioned in the Midwest. And in addition, we've recently expanded in the Carolinas and a bit into Texas. So we have this unique franchise with a lot of growth potential. Columbus itself, our headquarters city, is doing phenomenally well. We've been growing deposits every quarter. We've grown loans. And we're in a great position to continue to grow and frankly, to help the economy and our customers.
Now, there have been a lot of banks that have been criticized because they have too much commercial real estate exposure, especially the office, particularly with people working from home. You didn't get caught up in that. How did you avoid that morass?
Well, we put limits in place. We've been very disciplined, including who we chose to do business with. And very fortunate, we've got great customers, and they've taken care of us and their projects throughout these last couple of years in particular. So we have about 9% of commercial real estate loans to total. Our peers have about 15%, and we have around 1.5% of our loans are in office. So it's a very small percent, and it has a very high reserve against it. So we're in great shape.
Now, one of the things that I really appreciate you doing, why I like you come on so much, is I'm a huge believer in small business. Many believe the country's run on small business. Small business is the backbone of the U.S. economy. You have been a true champion of small business. How is that working for you at this point in the cycle?
Continues to be gangbusters for us. We do a lot of SBA lending in our footprint and elsewhere. The number one SBA lender in Texas, as an example, and we don't have branches in Texas. So we have a lot of business generated helping smaller businesses, some cases get started or get to the next stage. We find that to be a very, very profitable business and well run.
Now, how about these towns that, in the presidential election, I think you're going to hear a lot about towns that have been left behind, towns where they lost their manufacturing base. Are you seeing any comeback personally, because you're in the heart of it, where businesses are reopening that are larger, or is it the small business taking their place and we should just wait for them to become bigger business, and it's really a pretty good story?
Look, I think there's a partnership between business and government entities that can help spur economic development. If you look at Youngstown, a city that was really hard hit over the last couple of decades, it's coming back with one of the best business incubators in the country, and it has a variety of other businesses. And we're financing a lot of that. We have number one share in Youngstown. Toledo would be another example. The downtown section of Toledo has been revitalized substantially. The riverfront substantially revitalized. And again, we've been a big part of that. So we have a role to play. Other banks do too. And if you get the right public-private collaboration, great things can happen, as they have here in Columbus and Detroit.
Now, you have a tremendous and loyal group of people. I know in the Nashville market, a lot of banks have come in from out of state and are starting to take deposits, offering the equivalent of gifts to get people to switch. Are you having any problem with outliers coming into your area and trying to take your deposits?
Well, we've been around for 160 years, so we have multi-generational relationships with a lot of customers. We're probably feeling a little bit of pressure on the margin, but we're also growing. We're investing. We're putting new products in place, and our customer satisfaction is award-winning. We're a perennial J.D. Power Award winner for the consumer and Greenwich Award for the commercial customers. So we have a lot to offer, and we do it with our engaged colleagues that try to do the right thing and provide great service every day.
Is it your goal to become a national banker? I mean, you've been able to acquire because you've got a good balance sheet and the regulators like you. Is it just possible you can pick off different areas, or is that just too much to try to get your arms around?
At the moment and for the foreseeable future, we're very focused on organic growth. We've been investing significantly. One of the banks that took a different turn, there were only a couple of us after the Silicon Valley debacle a little over a year ago. We've been investing, growing the bank. We opened the Carolinas. We opened Texas. We have 5 new specialty banking areas, and all that's in addition to the core, which we're also investing in. So we have a lot of opportunity in front of us just growing the core.
Well, to me, it sounds...
And the second quarter results reflect that.
Yeah, they were terrific. To me, it sounds like I know a lot of people moving to regional banks. Maybe money should be going to the regional banks. You have much better growth than the big guys with much less risk, even. I think that's what really matters to me.
Yes, absolutely.
Well,
our risk management is very good.
Yours is very good, and it surprised people during the downturn, which was not a downturn for you. I want to thank Steve Steinauer, who's the chairman, president, and CEO of Huntington Bank. Steve, it's just it's a breath of fresh air every time you're on. Thank you so much.
Thank you, Jim.
Net Money's back in. Right.
Coming up, pop open those umbrellas and tee up your toughest questions. Cramer takes on all comers in the lightning round. Next.
It is time. It's time for the lightning round. Remember, that's why I'm for the lowest hated stock sale. Buy, sell, just put it on the core stock right in my step for the plan to sell. And then the lightning round is over. Are you ready, Ski Daddy? Time for the lightning round. Let's start with Jorge in California. Jorge.
This is Jorge, B-O-R-R.
Odd drilling name. I always go with the best, and the best is SLB. Let's go to Douglas in California. Douglas.
Booyah, Jim.
Booyah.
I bought this stock at 90. Do I have a winner in Blackstone Inc., ticker BX?
Oh, you absolutely do. And I want to go this one for the long term because they have a lot of great companies in-house that are going to do very well. I like Blackstone. It went up after everyone said it was a bad quarter. That was a mistake. It was a good stock. Let's go to Tyler in California. Tyler.
Hey, Big Booyah from California. How you doing, Jim?
I'm doing well. How about you?
I'm doing good, thank you. Given Dexcom's recent financial performance and market trends in the diabetes care sector, what is your outlook on its potential for growth over the next 3 to 5 years?
I was mystified and surprised at that conference call, which was absolutely terrible. My Travel Trust owns Abbott. It didn't go down on the horrible loss that they had in front of the jury on Friday. I think Abbott is a better play. Let's go to Charlie in New York. Charlie.
Reverend Jim Bob, I got Edward Life Sciences, and it's killing me. What do I do?
Well, you want to swap over to Boston Scientific, BSX, which delivered an amazing quarter and is taking share and taking names. Let's go to Ben in Ohio. Ben.
Hey, Jim, thanks for taking my call.
Of course.
What your consensus of Lowe's is.
Okay, Lowe's is the kind of stock that you should be buying right here, right now, ahead of the rate cut cycle, and I would pick some up tomorrow. Let's go to Darius in Virginia. Darius.
Hey, Jim, go Birds. My stock is Joby Aviation.
No, your stock should not be Joby. Joby, just sell it. I mean, I'd rather have you go buy go on DraftKings and do a parlay. Let's go to Sandeep in California. Sandeep.
Hi, Jim. Booyah.
Booyah.
Yeah, actually, last time I met you at Nvidia conference, and since then, the AI sentiment has changed, especially in the last 2 weeks.
I'm curious about your thoughts on Marvel, especially on the data center.
Okay,
AI.
I mean, there's two different things. The Marvel, the stock, is probably being hurt, but Marvel, the company, Matt Murphy, is doing a terrific job. I actually would own the stock. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, is China the weak link to this earnings season? Cramer's doing a deep dive into the region. Next.
If you own stock in a company that's expanded heavily into China, it's being killed right now. That's become a serious problem for the market, and I don't see it getting better anytime soon. We just don't seem to want to acknowledge the sea change. We know that there are many pernicious forces working against the bulls right now. We have the great multiple contraction that's always bringing down growth stocks right when a rate cut is about to occur. As I said at the top of the show, that's the moment when stocks of companies that don't particularly benefit from rate cuts suddenly go out of style. Think Nvidia. We have companies that are missing their quarters badly as we discover that their clientele is more on the ropes than anyone we thought. Think retail away from TJX, Costco, and Walmart. And we have companies that make data centers so necessary for the artificial intelligence revolution, or the companies that allow the electric grid to handle all this new power-hungry infrastructure. These are all for sale. But none are as dangerous as companies that rely on China for growth. Each day we find companies that have sprung a leak in China that we thought would have been plugged by now. We've discovered that the Chinese consumer is trading down when it comes to the goods that Procter & Gamble makes. If Procter hadn't gone so all in China, I think it would have made the quarter, and its stock would have avoided today's nearly 5% sell-off. This is a fantastic company. I think the stock will come back. We sold some Procter 166 for the Chapel Trust, and although we definitely don't run a hedge fund, we'd like to get back and buy that stock, but it could be restricted for some time. Things get restricted whenever I mention the company on air. If Merck hadn't run afoul of what looks to be the Chinese anti-corruption cops, I think its shareholders would have been spared today's incredible 10% skewering. Although I would probably still be down. It probably would be down still because of the rotation, because it doesn't benefit from rate cuts. And I can tell you, it didn't do anything wrong in China. So what's wrong with the companies that do business in the PRC? When you look at China, there's a lethal combination of a government that doesn't like America or American businesses and a populace that's seemingly more cash-strapped than any time in this century, even if they like our country. That's how Estee Lauder can completely implode thanks to Chinese weakness. Even as CEO Fabrizio Freda, at one time the cosmetic Houdini, can't seem to extricate his company from the PRC's clutches. Casinos that are anywhere near China, forget about it. Nike, they're pricing themselves out of China. Starbucks, their same-store sales were down 14% in China, which is their second biggest market. Horrendous decline, hopefully being made up by other areas around the globe. China's so darn complicated. At one time, their government was so business-friendly that Western companies thought it was insane not to go there. But their government took advantage of us on trade. And ever since the Trump administration, we've been fighting them in a trade war. As Gina Raimondo, the Commerce Secretary, made clear on our show last Thursday, the relations between our two countries are so strained that we have no choice except to protect Taiwan while we build our own semiconductor foundries here, something that antagonizes the Chinese to no end. Maybe one day our companies will simply throw in the towel or take some big charges like Heineken did yesterday when it wrote down the stake it had in a Chinese brewery, taking a $949 million hit. Tough pill to swallow. Nevertheless, Heineken owned up to the disaster that is China. And they're a Dutch company, for heaven's sake. Their government's not involved in the new Cold War. Unfortunately, American companies just keep saying, oh, it'll get better, it'll get better, it'll get better. Where do they get that confidence? I have no idea. In fact, if you want one more reason why the smaller capitalization stocks are doing well, it's because for the most part, they have nothing to do with China. Therefore, they have nothing to apologize for and nothing to write off. Still one more great reason why they can withstand the selling pressure while they await the rate cuts that will soon be upon us. I like to say there's always a bull market somewhere, and I promise to try to find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.